Right now, the United States stock market is closed. Looking at the latest closing figures for SoFi Technologies, trading under ticker symbol SOFI on the NASDAQ, the stock closed the session at $7.42 per share, reflecting a 1.85% gain during regular trading hours on volume of roughly 35 million shares. If you look at the surface narrative floating around retail trading forums, the conventional wisdom says SoFi is just another beaten-down fintech lender struggling against elevated interest rates and federal student loan headwinds. Most investors see a company trapped between traditional regional banks and modern digital trading apps, waiting for federal interest rate cuts to magically fix its margins. But if you look deeper into the capital flows, the institutional balance sheet shifts, and the underlying deposit growth, that consensus narrative breaks down completely. The market is pricing SoFi as a cyclical lender, but the actual quarter-over-quarter numbers show a platform transforming into a sticky financial marketplace where customer acquisition costs are plunging while net interest income climbs. When you analyze how retail trading capital moves across modern brokerages, you notice a distinct pattern. Retail investors often compare platforms like the Robinhood app, Robinhood Trading app, SoFi Invest, and Fidelity Brokerage when deciding where to store their savings and execute trades. The common belief is that Robinhood Crypto and Robinhood Cash Management dominate young retail traders, while traditional platforms like Fidelity Investments, Fidelity Mutual Funds, and Schwab Intelligent Portfolios capture serious long-term wealth. Wall Street analysts assumed SoFi would lose the battle for high-earning young professionals once rival platforms introduced fractional shares and high-yield cash accounts. Yet during recent trading sessions, institutional accumulation signals a massive divergence between expectations and reality. While everyday traders keep debating whether Tesla stock, Apple stock, or Nvidia stock will drive the next index rally, institutional desks have quietly been absorbing millions of shares of SoFi around the $7 handle. To understand why this price action matters right now, we have to examine the recent trading mechanics and volume profile. Over the last 4 weeks, SoFi stock has experienced aggressive short covering rallies followed by tight consolidation bands. Institutional volume spikes near support levels suggest big funds are establishing long positions on weakness. When traditional regional bank stocks faced capital pressure, retail deposits fled toward high-yield digital accounts. SoFi capitalized on this migration by leveraging its bank charter to offer competitive interest rates, effectively pulling low-cost capital directly into its system. While competitors relying on third-party banking arrangements saw their margins squeezed by partner fees, SoFi captured the full net interest margin spread. The market expected rising credit defaults on personal loans to wipe out profitability. In reality, net write-offs remained well within management guidance, while fee-based revenue for technology platform services grew at double-digit rates. Look at how the broader sector is trading today. When investors search for online investment opportunities or evaluate online investing platforms, they look at user retention and product cross-selling. In the current macroeconomic climate, self-directed investors seeking investment help or evaluating self-investing tools are moving capital away from single product apps toward comprehensive platforms. Someone who begins with a basic checking account might later explore SoFi stocks, SoFi ETFs, SoFi robo-advisor capabilities, or SoFi active investing. Every new product adoption drives down customer acquisition cost toward zero for that individual user. That structural advantage is completely ignored by short sellers who treat SoFi strictly as an unsecured consumer lender. When short seller interest spikes, options volume on SoFi tends to surge, creating heavy delta hedging pressure for market makers that amplifies daily price swings. What does this business actually do at its core? Originally founded as a student loan refinancing startup, SoFi built its initial reputation by targeting high-earning, credit-worthy graduates from elite institutions. Over time, management recognized that relying solely on student loan refinancing left the company vulnerable to federal policy shifts and interest rate fluctuations. To fix this structural dependency, SoFi acquired a full national bank charter through its purchase of Golden Pacific Bancorp. That single corporate move changed everything. Holding a bank charter allowed SoFi to sweep consumer deposits directly onto its balance sheet, cutting its reliance on expensive wholesale market funding. Alongside its consumer lending and banking suite, SoFi operates Galileo and Technisys, two technology infrastructure platforms that process back-end transactions for other fintech companies and financial institutions worldwide. This dual-model approach creates a recurring technology revenue stream alongside traditional banking net interest margins. When you contrast SoFi with traditional platforms, the difference in platform strategy becomes obvious. Established legacy companies like Fidelity Wealth Management, Fidelity IRAs, Fidelity Mobile App, and the Fidelity Trading Platform excel at managing existing generational wealth. Meanwhile, discount trading platforms like Robinhood Investments offer Robinhood fractional shares and Robinhood cash management to capture high-velocity trading volume. Interactive Brokers caters to international active traders who prioritize Interactive Brokers trading execution, low Interactive Brokers fees, advanced Interactive Brokers platform tools, and complex Interactive Brokers account configurations. SoFi chose a different strategy altogether, focusing on becoming the single financial home for ambitious young professionals looking to invest online through a unified ecosystem. The gap between expectations and reality becomes even sharper when analyzing recent earnings reactions. In previous fiscal quarters, whenever SoFi reported strong top-line revenue growth, skeptics immediately pointed to GAAP net losses or student loan originations. But when SoFi delivered consistent positive GAAP net income, the bear thesis had to move its goalposts again. Bears began arguing that high loan balances held on the balance sheet presented fair value write-down risks if macroeconomic conditions deteriorated. However, personal loan originations continued to show strong credit performance, largely because the average borrower profile carries a high credit score and substantial annual income. Institutional investors noticed that credit risk was far better controlled than equity valuations implied. As a result, every major earnings announcement over the past year triggered significant volatility, marked by high opening gaps, rapid profit-taking by short-term algorithms, and steady buying by long-term asset managers during midday trading hours. Comment below how many shares of SoFi you currently hold or if you are waiting for a lower price entry before buying in. Macroeconomic pressures continue to play a major role in how SoFi stock trades daily. Federal Reserve interest rate policy acts as a double-edged sword for digital banking platforms. Higher interest rates allow SoFi to earn higher yields on its personal loan portfolio and maintain attractive deposit rates that draw customers away from legacy banks. On the flip side, sustained high interest rates dampen consumer demand for mortgage refinancing and student loan consolidation. When bond yields shift rapidly, algorithmic trading bots dump high-beta financial technology stocks across the board, pulling SoFi down alongside lower-quality fintech names. This broad sector selling often creates stark disconnects between SoFi's operational performance and its stock market valuation. Smart institutional capital looks for these exact disconnects, accumulating equity when sentiment hits temporary troughs. Looking toward the future outlook, several catalysts could reshape how the stock is valued by mainstream Wall Street firms. First, the growth of the technology platform division through Galileo remains a structural catalyst. As traditional banks seek to modernize their tech stacks without spending billions on internal software development, Galileo's API-driven core banking capabilities offer an attractive plug-and-play solution. Higher margin technology revenue commands much higher valuation multiples in the equity market than traditional lending revenue. If technology platform revenue accelerates, Wall Street will be forced to re-rate SoFi from a bank multiple to a technology software multiple. Additionally, the continued growth of SoFi trading platform products, including expanded margin trading, options capabilities, and expanded asset offerings, directly target active retail traders who might otherwise choose Interactive Brokers trading stock or Robinhood stock trading. However, realistic investors must also weigh the genuine risks facing the company over the coming quarters. If the broader economy experiences a severe employment drop, even high-earning borrowers could face repayment pressures, forcing credit loss provisions higher across SoFi's personal loan book. Additionally, competitive pressures in the digital banking space remain intense. Major brokerages offering high-yield cash sweep options alongside low-cost intelligent portfolio offerings and broad intelligent portfolio options from major institutions means SoFi must continually innovate and maintain high interest rates on deposits to prevent customer churn. Regulatory scrutiny on digital lending practices and bank capital reserve requirements also poses an ongoing compliance cost that could restrict how fast loan originations can expand. When you weigh